Welcome to Indianomics. Foreign banks like Sumitomo Bank of Japan and NBD of Emirates want to own larger stakes in Indian banks. But the laws are not exactly welcoming because the Banking Regulation Act says no entity, Indian or foreign, can have more than 26% voting rights in a private bank. Now, it is tough for a Sumitomo Bank to convince their shareholders back home that they have 50% stake in, say, a Yes Bank, but only 26% voting rights. That explains why even the IDBI sale is taking so long. Separately, in PSU Banks, FPIs, now I'm not talking foreign banks, FPIs, foreign funds, can own only 20%. But there is no such a cap for private banks. FPIs can own up to 50, 74%. So the weightage of PSU banks like SBI and BOB in, say, the MSCI and the FTSE Emerging Market Index suffers. Does this cap need to go? For both these very important questions, I'm joined by former policymakers, actually, two former Reserve Bank deputy governors, Mr. Anand Sinha and Mr. S.S. Mundra. I'm also joined by a banking expert, Harsh Vardhan, senior advisor at Bain Co. Gentlemen, thank you very much indeed for your time. Mr. Sinha, let me start with the more easy rule first. This 20% cap for FPIs in PSU banks, is that even needed right now? Since, you know, can that rule be just dropped?
Well, you see, we have to see why there is a cap. Now, government has to have a minimum of 51% shareholding in a public sector banks. So for other shareholders, you have 49% available. Now, the cap of 20% for foreign investors means that in the non-government space, they can go up to 40% of shares. Balance 60% is there for the domestic investors. So this can be modulated. I mean, one can even think of a very market-based situation where you remove the cap altogether and live with the possibility that the entire 49% is taken over by foreign investors. So that is one scenario which can be thought of over a period of time. But I would say that there should be, you can tilt the balance in favor of foreign investors to a certain extent, but not crowd out the domestic investors. That is how I would look at it.
Okay.
So maybe you raise 20 to 25 to 30, but I won't think we are prepared to create a situation where domestic investors can be completely crowded out.
Okay. No, Mr. Mundra, let us look at it more from a stock market angle. I mean, practically, do you think any foreign fund or even set of funds will want 49% when you know that the government of India is going to call the tune in these PSU banks? Why should we even assume that a bunch of foreign funds will cartelize and try to buy 49%? The problem is, because of this rule, and I'll put up a table for you, which IIFL alternate desk has put out. Because of this, the weightage of SBI and BOB is less. It's a qualitative rule which lessens their weight in the MSCI, and they don't get enough foreign funds, even from passive funds. So, Mr. Mundra, your take. Can this rule be dropped? It's not serving any purpose.
Okay. Latha, there are, I think, to my mind, there are 2-3 angles to it. One, as Mr. Sinha has rightly pointed out, from any, nation's perspective, government's perspective, it would not be a great idea to completely crowd out the domestic investors. They have to have a say and pie in the public sector banking space. That is one point. The second point is the point which you mentioned. But tell me today, despite the government ownership, despite the government calling the shot, whether public bank performance is found wanting in any way. In fact, if you look at the recent history, I think they are performing better than their counterparts in the private sector banks. So that's the second point. The third point is, yes, from the perspective of the market capitalization of the bank, it will be a booster if the foreign investors can have a larger share, and the ultimately beneficiary for that would be the government. But looking to the recent history and where we are today, I don't think government is in a hurry to cash out on that portion. So to beyond the economics and the logic of it, I think there is a political part to it, there is a sentimental part to it, and ultimately, even if you want to do away with 20%, it would need an amendment in the Banking Regulation Act. So while the argument is tilted on both sides, I agree there is a room. Room is not that from 20% you go up to the 49%. There could be a midway. But yes, that would need a political preparedness. That is how I look at it.
Okay, two things, sir. I am not accusing banks of performance at all. But what I am saying is the presence of this cap, it is a qualitative rule in MSCI. Wherever there are such caps, since there can be a future restriction on the floating stock, the MSCI automatically gives it a lower weight. I will put up that table again for the benefit of our viewers. See, 20% is allowed. The maximum is 11% stake that foreigners have in SBI. In BOB, it is like some 5%. In PNB and other banks, it is in low single digits. It's not as if people are crowding even to the 20%. They will come when they feel like. So the point is, SBI, for instance, could have easily got $1.4 billion more of passive funds. They raised a QIP now. You know, instead of raising it at probably 800 rupees, they could have raised it at 900 rupees if this cap was not there. So, Mr. Harsh Vardhan, from a purely market point of view, since no purpose seems to be solved by this existence, can't we quietly drop it?
Latha, totally agree with you. This is a vestige of the nationalization era. It's old, more than 50 years old. And here there are several reasons, Latha. One is, if you look at a long-term view, you know, we say that our current banking credit to GDP hovers around mid-50s, and we want to take it to 130% as the part of that overall Viksit Bharat. I mean, our banking capital have to go to 50 trillion plus. If you just back of the envelope, where is this capital going to come from? And a lot of that will have to go into PSU banks. But otherwise, it creates a fiscal drag on the government. Every time these banks have to raise, and even if there is no NPA episode, even if the normal course of business, they have to raise capital, the government has to put out 70, 80%, whatever stake it holds. So I think you need access to deeper capital pools for the banking sector as a whole. And remember, this 26% threshold comes out of Companies Act, because after that you become significant minority. Public sector banks are not under Companies Act. Government is hugely privileged. It has 51% ownership, has entire governance with it. So I don't know where the hesitancy comes. My firm view is that we should allow it to go to 49%. Government will continue to own 51%. And look, I don't buy this crowding out argument. Look at the sectors where 100% is allowed. The nifty ownership of foreigners has gone down. So I don't see that to be an issue that should come in the way of allowing access of capital. And remember, now our regulatory capacity has dramatically increased. There are many instruments RBI has to deal with any governance issues that might come up with higher ownership.
Yeah.
By the way, even at 49, that 5%, 10% single ownership threshold will apply.
Yes.
It's not as if somebody is going to run away with 30% stake. And in case of PSU Bank, the voting cap is 1%, not 26%. Okay. So I'm saying, given all of this, I just don't know why the hesitancy should be.
Okay. Well, fair point. Actually, I'm in agreement with Mr. Mundra that the government has that much political capital, and this may be the smallest reason why they have to expend it. They may want to expend it for other reasons. And the other point being that, you know, we may say that if you raise the cap, we will get more capital. Precisely when you want the capital, when we were going through the asset quality review, that is when the FIIs will not come. They will come when you least want them, you know, when anyway the capital markets are friendly. But that's another point. I would very strongly vote with Mr. Harsh Vardhan on the issue that this is a vestige of a previous era and can be quietly dropped without making too much noise. But Mr. Sinha, you know, the more important question is not really public sector banks. This became important only because of SBI's QIP. But otherwise, it is in the private sector banks that one single foreign bank, and now I want to make this very clear to our viewers, we are not talking FPIs as a category, we are talking about one single private bank wanting to own, foreign bank wanting to own a larger stake in an Indian private sector bank. Mr. Sinha, do you think the time has come to remove this 26% cap on voting rights if it is a widely held institution? You don't remove it for, a single individual, a promoter entity. But if it is a Citibank, if it is a Sumitomo Bank, they're anyway widely held. Should we start this debate at least that this 26% cap needs to go?
So let me make two basic points and then I'll come to this question. The reason why there is a cap on voting rights, which alternately you could do by putting a cap on shareholding and having a one-to-one correspondence between voting rights and shareholding, is from the perspective that we in India have so far stuck to the point that the ownership and control should be diversified. It should not be too much concentrated in one entity. So that is one. The second thing is that it is an accepted principle and it is documented in RBI circulars that we do not want the Indian banking system to be dominated by the foreign banking system. And the current metric is about 20% of capital and reserves can be held by the WOS and branches. So this is the scenario. Now, the second one has come out of the experience of global financial crisis. And this is not something which only India practices, which others also practice. Now, coming to your specific question, you see, there was a time when there was a cap of 10% for promoters and for everybody else. They were all on par, and even the voting right was capped at 10%. Then it was raised to 15% for promoters. That is, the idea was to create a better status for the promoter compared to non-promoters. And now it has been raised even to 26%. So that is the idea. But there could be situations where you may have to allow more than 26% shareholding. Supposing a bank is in distress and a foreign bank wants to take over. So that is a situation which is a perfect situation for allowing more than 26% shareholding, but the cap on voting remains at 26% for the reasons which I explained.
Yes.
I would agree that the cap should be operated on shareholding limits, rather than through a disconnect between voting power and shareholding. Now look at subsidiary, a foreign bank subsidiary. Now there is no equivalent for Indian banks because in India, a bank cannot have a banking subsidiary. So this is something very exclusive to foreign banks.
Yeah.
Now foreign banks, we allow them 100% ownership. Now here, the voting limit has no meaning at all. No meaning. It is, in a way, you can say it is 100% voting rights.
So,
now, the moment...
Mr. Sinha, actually, we are running out of time. We have to take a commercial break. We will continue the conversation after the break. But I suspect on this issue as well, Mr. Mundra's former point that political capital of the government is limited, and will they use it to remove the voting rights cap of 26%, that too to help a foreign bank, looks a very remote possibility. But it is worth debating whether we have to remove that cap because India is in a growing growth path and we will need foreign capital sooner or later. Those questions after the break. Back in a minute. Bazaar viewers, you can catch the full show after market hours on Indian.